You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the aforementioned network. And if we sound a little bit different, it's because we're not coming to you from our studio in Chicago today. No, we're coming to you from scenic and sunny Florida at the Options Industry Conference here. And this is a great event because we get a great chance to catch up with people from all different aspects of the industry, including our next guest, Jim Toes. He is the president of the STA. Jim, welcome to the program.
Thank you so much for having us today, Mark.
Jim, as we are wont to do with all of our first-timers here on the network, why don't you go ahead and give us a little bit of an overview of your background in the space and how you found your way over there to the STA?
Sure. So the STA is a trade association that's been around for 85 years. We were founded in 1934 in response to the SEC, which was also founded in the same year under the Securities Act of 1934. So it was a group of individuals that held their first meeting in the fine city of Chicago I've
heard of it.
You've heard of Chicago, I'm sure you have. And the mission statement today is very consistent with the one that was originally formed, which was to be an industry group to face off with the newly formed regulator of the SEC.
And you're obviously down here at the Options Industry Conference, even though you're primarily, as it says in your name, Securities Traders Association. What brings you down here to the OIC? What are some of your interests here at the event?
Yeah, so the organization is very diverse, both geographically and also in the skill set. So we have 20 affiliates in the U.S. We have 4 up in Canada. One of the largest affiliates, obviously, is in Chicago, where there's a tremendous amount of options activity. So we have a lot of options members. And we've, in the past, I would say 5 to 6 years, our interaction with the options community has picked up dramatically. And I think one of the catalysts for that reasons is when you have regulators down in D.C. or staff members on the various congressional committees, most of them have like an equity mindset on how they look at market structure. So I think the options people, as they kind of were seeing some of these equity regulators with the equity market mindset, we're looking maybe for a resource in that area to maybe have a relationship with these folks who are making decisions about their market structure.
It makes sense because at the end of the day, everyone wants a decent regulation. As challenging as that could be to find. Now, it's interesting. We have you here from STA, but as you mentioned, a lot of which is kind of the mothership, but a lot of our listeners may be familiar with your various chapters. Of course, there's STAC in Chicago, which is a big event every year. There's STANI in New York. You pick the area of the country. There's an STA affiliate there somewhere. Probably a lot of the listeners are probably familiar maybe with their local affiliate or branch of you guys, even if they're not familiar with the mothership, which you probably, as you mentioned, your day-to-day is probably more based on the regulatory side and dealing with all the fun things that are going on over there. You must be, you're probably not that busy at all these days.
Yeah, I mean, listen, the affiliates themselves, like you said, they're independent. And even though all of them have like an STA somewhere in their title, STA Chicago or Boston STA or STA New York, the affiliates themselves they have unique demographics among the membership. Boston and Denver tend to have a high concentration of asset managers. Chicago, like I said before, has a fair amount of options. And St. Louis, we have a very large St. Louis affiliate, it's very strong, and that tends to be a lot of the retail brokerage firms, the E-Trades, the Scott Trades, and Ameritrade. So even though these affiliates, like I said, all have STA somewhere in it, when you start getting into the demographics and the makeup of each affiliate, the business models are very diverse as well.
So how challenging is that for you as a person who's kind of governing all this? You go talk retail on one day to one affiliate, you go talk options in Chicago, you talk mutual funds and asset managers in Boston. It's got to be pretty challenging to stay on top of all these myriad different demographics within the space.
Yeah, well, true, but it's bizarre because in some ways it gets easier every day because our markets, they used to be very siloed, and there wasn't a lot of activity going from options into equities, or asset managers tended to only play in one particular area, in equities or options or futures. And now as the market structures have evolved, where things have become much more electronic and the connectivity across asset classes, there is a lot more people in equities who are doing stuff in options that haven't done it in the past, and vice versa. So in some ways, while the job is challenging, to your point, to kind of be, I don't want to say I'm an inch deep and a mile wide on some of the subject matter expertise, but the market is definitely moving towards almost like one virtual marketplace across all asset classes, because the ability for money to move from one asset class to the other is becoming much more efficient over the years.
And obviously, you're based out of D.C., so your main purview is on the regulatory side. There's a lot of different issues, a lot of different things going on there. If you come to the options conference like this, there's a lot of concerns about liquidity, a lot of concerns about bank capital rules. If you get into the equity realm, there's all sorts of different things. What are your primary focuses these days? What's taking up your time on the regulatory front?
Yeah, and that's a great point, right? Because sometimes I do, excuse me, some things that we've seen occur in equities, we do feel like are starting to play themselves out in options. Okay, so yesterday we talked a little bit about, the fragmentation, right? So we have fragmentation in the equity marketplace at the exchange level, and also at the dark pool levels, and the ability for firms to internalize their order flow. And how is that fragmentation different than the type of fragmentation where we see in the option space, where it's really just fragmentation at the exchange level itself? So those are different. One area where we do have the same concerns, I think where it exists in both equities and also in options, is just a concentration of activity being done by a small set of broker-dealers or market makers, and how the barriers of entry for new participants to come in is so high that that's an area of concern. So on the equity side, when we looked at what happened in the Facebook situation, the part that we always were concerned about was like, that should have been a wake-up call for all regulators, that the amount of retail order flow that is being handled by only 4 firms, and that should be a concern. And when we hear things around 80% of the activity is being in options is being done by 4 market makers or 4 BDs, that's concerning to us.
No, you bring that up. That's a topic I've been pretty much addressing with everybody who comes through these doors over the course of this conference, because it's a concern, and it's been a concern for a number of years. And we see, the stats at a conference like this. You mentioned the 4 market makers. We see, 19 names doing half of all the volume in the option space these days. So there's a concentration of liquidity, there's a concentration of market makers. The two might go hand in hand. But I'm curious, as you're seeing all this unfold, what do you think we could do maybe as a broader on the STA front, or maybe specifically in the option space, to help reverse that trend, particularly on the market maker side? Because it's been a long time since we've seen really a major firm say, I'm diving into that space anew. We saw obviously the sale of the former IB market making group there. That's kind of one of the few changeovers you've seen. But other than that, it's been kind of the same players for a number of years, and that number has been dwindling. What can we do as an industry to try to reverse that trend?
Yeah, for us, it's sometimes you'll often hear us say about regulators need to find a way to incentivize market makers, market making activity. And as soon as we say the words incentivize and market making, they think automatically that we want to blow the spreads out, allow them to charge more money, and incentivize by increasing the revenue line. And that's really not what we're looking for them to do. If you can decrease the cost on something, $1 saved is $1 earned. And we just feel that the regulators should be looking for ways to incentivize market making, and really taking it from the approach of what can we be doing around the cost side, of reducing the cost and making the barrier of entry for new participants to come into the marketplace.
You mentioned spreads, another hot topic here at the options conference. I know it's debated throughout the financial industry, but it's become very contentious in the options space in the last year or two, which is the notion of auctions, which are contributing to those spreads. We see most of the trades going up these days, particularly on the retail side and the small lot side, and these price improvement auctions. And as a result, we're seeing spreads markedly widen out because market makers have no incentive to show their best hand because they can show that later. I'm curious what the official view of those auctions is at the STA, because it seems like they're very divisive. Some groups really think they're great protectors for market makers, help them avoid risk. Others think they're really dramatically impacting negatively the option space. I'm curious. Where does STA fall?
To me, auctions is the sharpest two-edged blade I've seen. All right,
it's a good description. I like it.
It is.
I may have to borrow that.
You can. That's fine. I just made it up. That's really good. No, but it is. On the one hand, there is that camp that they have a very strong argument or case to be made that auctions are causing the spreads, and then there's a very equally strong case to be made that auctions are a way to deal with the spreads. Or yes, this thing, we want to talk about spreads. Those are quotes, but at the end of the day, do we care about the quote or do we care about where the trade actually goes off? So I think that it's a very strong case on both sides that, yes, we can definitely see how auctions are causing the spreads to blow out. But on the other hand, I don't think we would be looking for any type of an outright ban on them because they are definitely a means to react and they're definitely means to to help with the spreads that exist.
Yeah, if you got rid of them right away, you'd have to find something else to stopgap there, right? Because just because you get rid of auctions doesn't mean the spreads are going to magically. If liquidity providers could provide that liquidity, they probably would. So that's probably also emblematic of what's been going on in that space for so long and how damaged the liquidity providing space is outside of those top 20 names out there. So yeah, it's a contentious issue. I've yet to hear anyone come through here, which is I think that's why I think the double-edged sword is a good description because I've yet to hear anyone make some sort of proposal that doesn't have its own unintended consequences as a result.
I think the solution. Listen, I think that spreads are a problem. I just think that the solution is somewhere else.
It's funny.
And where it is, I don't know. I don't know, but the solution has to be found somewhere else.
People have always said for years that spreads are the advertisement for the options business. That's our ad. People see that. That's great. We want to trade that. Lately, the ad isn't so good. So people are seeing that and saying, well, maybe I don't want to trade. I want to close my laptop and go back to my job or whatever it is that I was doing before I decided to trade.
Listen, there was a very similar situation in equities, and there was a hearing recently at the SEC on thinly traded securities, and Frank Hathaway from NASDAQ was very articulate on bringing up the point that in the old days, like only 1999, we're not going back that far, that when you used to punch up a symbol on a security, you would see a four-letter symbol, or for Merrill Lynch, Citigroup, and there was attribution to that, and if you were an account trying to look for liquidity, and you saw that Merrill Lynch was on the bid, they were advertising. You would call Merrill Lynch. That's all gone away now, right? You don't see those anymore. It's all the electronic market making, and then liquidity entering the marketplace through there.
Yeah, you're right. That transparency has definitely moved away as we've gone to this. Speed and transparency not always go hand in hand. Well, you guys, you mentioned you have the affiliates, but you also have some of your own functions, and I know you have your big annual event every year. I believe it's in October in Washington. Tell us about that and what some of the focuses of that event are.
Yeah, so I mean, we're very excited with the board made a conscious decision around 5 or 6 years ago to kind of keep the annual event in D.C. And we made it for several reasons. One is that we do hold ourselves out as a grassroots organization because of the 20 affiliates. And when you look at the congressional members who have oversight of our industry, they do tend to come from those districts. You have one later on speaking today, Congressman Hultgren, who's out of Chicago. He sits on the committee that we all care about that has oversight of the SEC. So we started having it back in D.C. Around 2012. We went back. And one of the benefits that we really found that we were not expecting to see is that so many of the staff members at the SEC and on the House and Senate side, these are the folks who don't really get a chance to travel that much. They're not the ones getting out of town to come to these wonderful events at this wonderful venue that we're at today. They come to our event in D.C. And it's a lengthy process, which I won't bore you about. We have to go through the House Ethics Committees to get the invites. But to have them come to D.C. and have them be in the room with the diverse crowd that we bring in as far as broker-dealers, exchanges, asset managers, retail brokerage firms, principal trading firms, all in one group, all in one room together. It's a very positive vibe.
Everyone you talk to interacts with DC. They all say it's the same thing, that it's really the staffers who get the work done. They do the research. They learn about the bills. They write the things up usually. So if you can get them to your event, you're probably a long way towards getting the congressmen and the senators to come along as well.
Without a doubt. We always recommend, if anybody has a government affairs strategy, we always encourage them that if you make 3 trips down to Washington, D.C., you should go down. One of those trips should be when the congressmen are not in town. All right, you'll find the ability to get a meeting with the right staff person. It'll be a much more meaningful meeting. You'll be able to actually talk without 4 people in the lobby waiting to get in. So the staff members are very important, and it's not that big of a universe. We're only talking about 50 or 60 relationships.
So you've been interacting with the Hill for a while. How would you say the climate is there towards these types of reforms you're looking for in the industry? Are they starting to become more open, more receptive when you're coming down there, or are they saying you guys are causing all these problems, we don't want to do anything with you? It seems like there's a little bit of a push and pull with that. How has that climate been recently?
Well, I think the biggest struggle that we deal with down in D.C., and again, this is kind of coming from the equity background, is that equity folks walk around on pins and needles all the time because something can blow up anywhere in the financial services industry, and they always come to the equity markets to regulate us more because it's the one that they understand the most. You look back at the 2007 financial crisis. The equity markets did not cause that. As a matter of fact, we were the only marketplace in that week after the Lehman collapse that the markets opened at 9:30, they closed at 4. You may not have liked the price that you got, but your trade cleared, and we were the only source of liquidity around. Well, not the only source, but we were a primary source of liquidity for people. Auction rate market had gone away, CMBS market had gone away. So I think that's something we always have to deal with, is that when you go down there and something happens anywhere in the financial services industry, if you're looking to address it, please address that asset class. And don't be stepping into the equity markets. We're regulated enough as it is today.
Yeah, we hear that refrain a lot. Yeah. Well, Jim, I'm glad we can get you on and catch up with all the things going on at STA. But before we go, if you want to leave our listeners with any hints, any teases of what's coming down the pike from you and your team over there at STA, now is the time, sir. The floor is yours.
Well, that's great. No, we just hope we have see people in D.C. in October. I mean, we've had back-to-back years where we've had 250 firms attend the event. It's a very diverse group. We're always very honest in saying, if you have a government affairs strategy, 80% of your money, time, and effort should be with an association that represents just your business model. So if you're a hedge fund, you should be with MFA. But that 20%, we're the only association out there that tries to bring all the participants into a room together to talk about our financial services industry.
And Jim, if people want to learn more about your event or some of the other initiatives you have going on at STA, where should they go? What should they do?
SecurityTraders.org.
It's pretty easy. Well, Jim, it was great getting you on the show here, and maybe I'll have to make my way down to Washington one of these days for that big event and check it out for myself.
Come down as a guest.
Great. Thank you.
Thank you.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.